Let me now bring on board Mr. Yuvat Bhatt, Managing Director with Dalton Capital Advisors. Mr. Bhatt, good morning. Thank you for joining us. It's been honestly a one-way street for Indian equities. Nifty in quick time has lost nearly 300 points and Sensex has taken a hit of nearly 1,000 points.
Quite bad. Basically, I think what has changed is that FIIs have started nibbling away from the Indian market just a bit, probably less than $500 million over the last few days. And given the fact that the Indian market is quite vulnerable to FII movements, either positive or negative, and given the fact again that domestic investment institutions really don't have the muscle to take on any selling from FIIs, even a small bit of selling has had a dramatically high impact on the market, and that is what we are seeing. In addition, of course, there is certainly a risk of trade internationally, largely because with all the pump priming that we have seen in the US, there is some element of stability. There's new pump priming in Japan. So therefore, given the fact that all this money has to find some find some destination, and given the fact that the developed markets are doing reasonably well, most of them are at actually historic highs. So quite a lot of money is getting out of the risky assets, which are basically emerging market and India-like markets, and getting into the developed markets where money can be made. If you really see the divergence between, say, for example, the Dow and the Indian market, year to date, that is the last 3.5 months, there is a divergence of something like about 18-19%. So therefore, that's a huge outperformance by the developed markets vis-a-vis markets like India. So therefore, that's where the money is now going. Given again that the Indian economic situation has really not helped, the twin deficits continue, and issues about the lack of export growth, inflation, interest rates not really coming down, all these issues are not addressed. And if you really see, the movement happened after September when there was a change in the stewardship of the finance ministry, and we're back there now. Because all the announcements that happened post-September, they're probably, at least the market thinks that there's not enough follow-up action, and that is why probably the market has given up on all those announcements.
Mr. Bhatt, hi, morning. So
Hi.
What's your sense about, the upcoming earnings season? I mean, Friday, Infy kickstarts the earnings. Could the earnings season be a game changer, or do you think it's going to be all negative in any case?
Well, I think one or two companies might do well, but I think on the whole it will be probably a disappointment. And if the economy is not doing very well, and if you can see as margins are under pressure, companies are not able to pass on cost increases, it has got to finally show up in results. And so therefore, I think the expectation results are not very high, but even those low expectations might be somewhat difficult for corporate India to meet, except probably a couple of companies on account of special circumstances. So therefore, the earnings momentum may not be the reason for markets to really be expecting a bounce. Plus, again, whatever was possible on account of re-rating, the 23-24% return that we saw in dollar terms in 2012 calendar, that has sort of ensured that all the re-rating potential has been addressed. And today, if you really see, even though based on historic valuation parameters, India might look like reasonably valued, but I think given the growth outlook being much softer than what it used to be, probably the market is at some sort of an equilibrium at current levels.
At a time when markets in general are in some kind of a profit booking mode and quality stocks are taking a whack, do you think in the near term quality stocks will underperform Indian markets? When I say quality stocks, large cap IT companies, consumer staple names, private banks.
Well, the big stocks have to perform generally in line with the markets, because they account for quite a large weight in the market indices. But having said that, I think there will certainly be some which could do better than the others, and the defenses are the ones which probably are the sort of stocks that can help you spend good sleepy nights. So therefore, I think IT seems to be one which might not be very bad as an investment destination today, given the situation that overall the sentiment is quite weak. And of course, defensives like FMCG, pharma, and these continue to, and private sector banks, these continue to be the favorites of the markets, because these are the ones which are unlikely to fall as dramatically as the market itself. But the cyclicals are the ones that are taking the brunt, and they will probably continue to take the brunt in a situation where FIIs continue to sell, and in a situation where domestic institutions are not able to support the market to the extent they are expected when FIIs come to sell. But having said that, if, say, for example, the problems in Europe, which is basically a worry about the contagion effect of Cyprus, you already have incipient problems in Portugal as a result of the Cyprus episode. So I think if these things are contained, and if we have some more confidence returning to Europe, the risk of trade might come off, because as we have seen several times in the past, when there's such a huge dissonance between performance between the developed markets and the emerging markets, like say between US and India, of the order of about 18-19%, there's always some sort of quick money that comes and tries to bridge that gap. So that is a possibility sometime if it is supported by some sort of public policy action by the government. So that is a risk that that we have to keep watching. But otherwise, it looks like as if it is worthwhile watching the developments in Europe for possible cues about FII flows.
Mr. Bhatt, what's the expectation from INFI and IT in general? Would you start getting cautious?